Welcome to a special segment on IIP numbers which are just flashing on your screens. The number has come in at 6.7%. It's a record number. Why I'm saying record? Because as per we were having discussion in the newsroom, the last time this number came in was last year. So the highest number in the calendar year so far, although December number is still awaited and that will come next month. But for now, 6.7% IIP, which is showing huge kind of activity which is seen in the industrial area. Now to make a sense of what does this headline number means, does this signal better earnings for Q4 of this year? And we need to wait and see for that. But for now we are joined by Aditi Nayar, Chief Economist ICRA, as well as Gaura Sen Gupta, Chief Economist at IDFC First. Gaura, I want to come to you first. 6.7%. Does this signal something?
Definitely, it shows that your consumption engine is being fueled by both urban as well as rural, and as a result, the production activity has responded. The October IIP was really reflecting a loss of working days because of the placement of Diwali. So Diwali this year fell in the middle of October. Last year, we had Diwali towards the end of October. So the November IIP, is also reflecting the fact that this year we've had more working days compared to last year November, where we had less working days because of the placement of Diwali. It also shows the fact that there was some inventory destocking that happened in response to the GST cut in October. You saw a sharp slowdown in e-way bills, which also grew by around 22%, almost 20% plus in the month of November. We're also seeing other indicators. You look at production activity in the sense of electricity demand that has picked up. Demand indicators for even for the urban area, for example, you look at on the import front, consumer-oriented imports have picked up. You look at even within the bank credit, there has been quite a response to the GST cut. We've seen a pickup in credit card spends. We've seen a pickup in consumer durable loans. So it's basically showing you the impact of GST as well as larger number of working days that came in November. It augurs really well for Q3 GDP, which is expected to be significantly higher than RBI's estimate of 7%.
Definitely, and that is a signal which is coming in. Let me also bring the constituents of IIP on your screen. Mining has come in at 5.4% and manufacturing at 8% versus 1.8% month on month. I want to come to you, Aditi, for reaction on mining. That has come as a surprise.
Just before that, I think overall the way we usually look at the IIP numbers for October, November is to average them out instead of looking at either month in isolation and getting, swinging between despair and hopefulness. So I think possibly we need to do that only if you look at the chart which is flashing right now from 3.5 to 4 to 4.6. And then the dip and then the pickup. The average for these 2 months is still below the average for Q2. So I am not going to get too excited by this number unless we are able to sustain a very good momentum in December. So I think fingers crossed, most likely in my view, a lot of this is reflecting the higher number of working days on a YOY basis, and therefore, we are probably likely to see a bit of a dip in the month of December, notwithstanding restocking after GST and the overall demand momentum after GST.
Aditi, let me bring two numbers here. Electricity last month was minus 6.9% and this month also in negative territory at minus 1.5%. Even if you average out, it is in negative territory. What is your reaction on that, Gaura?
That is a reflection of temperature variation. We've had colder winters, so it's expected to be softer. So I wouldn't read electricity supply contraction as an indication that production activity is slowed down. You must look at IIP in conjunction with other indicators. So if you look at freight transportation, you see cargo, you see GST e-way bills, you look at other transportation services such as shipping cargo, aviation cargo, everything has registered very strong numbers for November. I take that point from Aditi that you should look at October and November together because of the working day impact. But even when you take that into account, looking beyond the IIP, you look at the other consumption indicators, you look at two-wheeler sales, you look at passenger vehicle sales, you look at the fact that under NREGA, the work demand under NREGA has been declining consistently for the last, I think, 4-5 months, which is indicating that rural labor market indicators are doing better. So all in all, it does show there is a response in terms of growth momentum, which does show the impact of the GST cut on the urban side. Rural has got help from not just, I would say it's more a reflection of the monsoon and the fact that rural wage growth is, over the last couple of months, has been slightly beating inflation, so which is supported. In the case of urban, we are a little more hopeful on the sustainability of the consumption, and that would be because urban wage growth from Q2 has begun to pick up. We need to see more quarters of a pickup in urban wage growth, and that will be the key factor for sustainability of the consumption side.
Similarly, I want to understand on manufacturing as well. Last month it was over 1% at 1.8%, and this month it has come in at 8%. Even if you average out, it is a decent number, Aditi, right?
Yeah. No, absolutely. I think manufacturing has done quite well, and I agree with Gaura. Electricity is reflecting more of household demand and agricultural demand, particularly the change in temperatures as well as the rainfall activity. And if I remember correctly, the numbers for December are tracking, at least they're tracking a positive number. So, that will turn around in December. And also the correlation in general between electricity growth and industrial output has weakened quite a lot because there's a lot of captive generation now. And also on the household side, we have a lot of rooftop solar panels, etc. So that correlation has come down quite significantly. Manufacturing, the number itself, the average for October-November at around 5% is quite healthy, and that is reflecting the benefit of the GST cuts and the festive season demand pickup which was there. The sustainability is something that we need to look at. I think, if you look at the underlying numbers across the different use-based categories, a lot of them are looking pretty healthy in the month of November. Typically, exports are a bigger driver in the month of December. So let's see with the US tariff-related uncertainty how we're finally going to see exports panning out in the month of December, and that would be a big driver as well in addition to the domestic demand.
Gaura, let me come to you. Hi, this is Ankita also joining in. Gaura, I have two questions for you. One is that the kind of upside surprise that we are seeing, the last time we saw this kind of a figure, 6.9% was last year in May. Firstly, is this number sustainable? Because like you mentioned, there were more number of working days, we had the festive season. Is this number sustainable going ahead? And secondly, is this going to lead to better earnings? Because that's one trigger that the market has been really watching out for a re-rating to happen.
So again, agreeing with Aditi is saying that you should look at it in terms of October, November together. And yes, December there will be some moderation. It has to be because of the normalization, the working day impact that will happen in the month of December. But if you look at overall, IIP has many limitations. It's on a very old base, it's highly volatile. And even in the GDP, IIP would be, let's say, 25% of manufacturing GVA is explained by IIP. Majority of your manufacturing GVA is listed company performance. Services also a large part of our GDP component gets reflected by how listed companies are doing. Now in Q3, margins are supportive because we saw WPI inflation turning negative. The gap between non-food manufacturing and the industrial raw material index that we calculate from WPI widened in Q3. So margins are supportive. Q3 is the quarter where you are going to see urban as well as rural pickup. So you can see this net sales growth should be stronger than what we saw even in Q2. In Q2, actually, if you see, listed company profit growth was led by pickup in sales growth. The support from margins was not there. It was more pickup in the sales growth which helped the profit growth in Q2. Q3, you will have both. You will have sales growth as well as margin support. We definitely expect that listed company performance, the profit growth should be better. And Q3 GDP will get also support from a deflator from the perspective of your WPI is negative. So your GDP deflator growth will also be negative. So you'll get an additional boost to real growth. So we expect very strong numbers in terms of GDP for Q3.
Aditi, now these numbers translating into the GDP growth is something which market would want to understand from this, and therefore I'm asking you whether or not the guidance which is given by Reserve Bank of India based on these numbers, do you think that there is a case of a positive surprise?
Look, couple of things. As of now, I think I'm not as optimistic as Dora. I think the number is going to be around where the RBI had mentioned. But of course, we have to keep in mind that that's on the old base. And the data that we're going to get for the next quarterly GDP print is going to be on the new base. So the numbers, both absolute and YOY growth, could look very different from what we're penciling in, what we are projecting right now. So I think we have to keep that in mind. I do think that there is a little bit of, we need to be a bit more watchful of some of the trade numbers as well. So, I'm still in wait and watch mode. My full year growth projection for FY26 is 7.4%. So it is a little bit higher than the RBI's, but not materially different.
You, since we do not have any clarity on the India-US trade deal, our exports have been rather, on the back foot. Do you see a rebound in exports, and therefore, of course, any upside surprise would also buoy the manufacturing, side, because manufacturing is anyways doing well. But if the tariff news comes through, if there is a positive tariff trigger, could that lead to a positive upside as well?
This question is for me?
Yes, Gaura, this is for you.
Oh, all right, thank you. So there is a very strong link between manufacturing sector growth and export growth. So the fact that our IIP is still holding up when we have a 50% bilateral tariff is in a way commendable. We got a little lucky in FY26. We saw significant front loading of exports to the US. That continued till the month of July. I think on a monthly basis, we saw growth rate, year-on-year growth rate around 20% to the US in terms of export growth. So that has balanced out the negative impact that we are seeing from, let's say, the month of September, October. Though the month of November, our export growth to the US had picked up again, maybe around 20% growth on a nominal base. But again, that's a working day impact. But on a net basis, because of the front loading, a large part of the negative impact of the 50% bilateral tariffs has got balanced out. So we are not, if we get a trade deal, let's say by the way it's going, I think it may take maybe till the end of FY26. But if we do get a trade deal, it'll be very positive for FY27. For FY26, we are safe because of the front loading that has taken place. So on a net basis, the impact of the tariffs has not really been felt for FY26. It's more relevant from FY27 perspective because as a large part of our exports, around 45%, are MSMEs, and these guys are operating at very thin margins. So they can absorb the impact of 50% bilateral tariff for a while, but it's not for such a long period. You will see permanent scarring in, let's say, the order books of these companies if the 50% bilateral tariff extends beyond FY26. So if, let's say, we get a trade deal sometime this year in FY26, India's tariff gets reduced to maybe 20% to 25%, basically at par with other Asian countries. Yes, that will be very, very positive for FY27, specifically for the manufacturing sector, which is closely linked. If you look at the correlation between manufacturing production and export growth, it tends to be pretty strong. So yes, it will be very positive, but I think it's more important from FY27 perspective.
You spoke about manufacturing. Now there are a few outliers there even in these numbers. Consumer durables at 10.3%. If you talk about infra goods, that has come at 12.1%. I want to understand from you which are the sectors where you see that you're completely surprised, and which are the areas you think that the growth is muted than anticipation.
So, consumer durables, I think, is broadly in line with what we would have expected, because we did have a lot of goods just flying off the shelves in the festive season, especially after the GST rate cuts. And restocking was expected to drive the IIP volumes in this month. So that I'm not surprised by. And even on the infra construction goods, couple of things. I mean, definitely we were expecting that after the rains are over, and then after the festive season is over, government capex should be picking up quite a bit. So maybe this is an indication of higher government capex spending. We'll get Government of India's fiscal numbers in a couple of days, and we'll be able to get a sense of how the month of November has moved. Now, interestingly, the headroom left for capex spending for Government of India is actually lower than last year for the remaining part of FY26. So it'll be interesting to see how things move. Are they able to increase the allocation for capex so that we don't end up with this YOYD growth? Because that could be quite supportive for the IIP and for overall GDP growth in the second half of the year if the allocation is increased. Otherwise, that could emerge as a headwind for growth in the last quarter especially.
All right, Aditi and Gaura, thank you so much for your time and putting these numbers into perspective. A 2-year high number for IIP at 6.7%, and more importantly, the numbers are surprising markets, right, Shivani? We were anticipating somewhere between 2 to 4% was the forecast which was given, but the number has completely surprised markets. And you think market will take it with both the hands?
Of course.
Hopefully,
Yeah.
hopefully given